Welcome back to Be Rich. After Namakkal, my team decided to do an event in Vellore. We have familial connections with Vellore. My father went to college in Vellore. He attended the Wooders College. So we are doing an event in Vellore on the 20th and 21st of July. Those desirous of attending this event should contact the WhatsApp number given below and send a message to the Gmail ID that is also given. Try to call as early as possible to avoid rush and disappointment. Because in Namakkal, we had to decline a lot of people who wanted to attend the event. Once again, I thank you for supporting BRIDGE.
Hey guys, welcome back to Be Rich. Before we get to the video, I know all of you are waiting to see what we have in store for you today. But before we do, there's an important disclaimer which we have to put out is that we are not SEBI registered advisors. We never claim to be, and you have to take all your investment decisions in consultation with a SEBI registered advisor or someone who's competent enough in that field. We are not those people. We are purely just giving you information and discussing it amongst ourselves as a purpose of a hobby.
Hi everyone, welcome back to Be Rich. It's me and Shashwat here back with you guys again. He has got something interesting which I don't know what it's about because usually he gives me a brief about what we're going to talk. But today he's blindsided me and he said, "Come, Mama, there's something I want to talk about." So we're here. So let's find out together what Shashwat was, what he has to offer us today.
Yeah. So this is something we've always discussed before, as always, most discussions, because we love talking about investing in markets. So it's anyway. Before we get into the topic, I wanted to talk about how I've picked up The Intelligent Investor again. I've read this book twice. I'm reading it for the third time again because you have to keep rereading books which you think are interesting. And this is something which I thought would benefit our audience as well. So once you're done with The Intelligent Investor, I'd recommend that reread it again because you'll get a load of fresh new insights by giving this book the time and love it requires. Anyway, getting back to topic. The topic today I want to talk about is the risk of investing in bonds. Because this bonds are something which we've talked about and the benefits of investing in high tier corporate bonds, but we haven't really covered what risks are really involved with bonds in detail. And that's something I wanted to dedicate today's video to. So, I'm going to be referring to an article by someone who I follow on Twitter. This person is someone who posts write ups on investing. He's called The Rational Walk. You can find him online. So, what we know about bonds is that there is some amount of risk to it, but it's very nebulous as to how the risk really plays out in comparison to stocks. Because if someone talks about risks in stocks, they say, okay, look, the price can go down. Tomorrow, the company can go bust. Or three, you just made a wrong call on the valuation. So, about three main ways in which stocks have risk attached to them. But when we talk about bonds, it gets a little more difficult to really pull it apart and see where the risk lies. So, this is why we wanted to make this video. There are three types of risk. And once I go through each one, what you think about the risks of bond investing as well. So, the first risk involved in buying bonds is that there's a credit risk. So basically, the issuer of the bond may fail to pay the interest amount or the principal amount because the underlying company goes bad or goes bust. Suppose you lent to a company which had gone bust, maybe Anil Ambani's company. You had bought his bonds, and tomorrow he said that, look, I'm bankrupt, I can't pay you back. Then in debt recovery, you would have made maybe 20 cents on the dollar or 20 paisa on the rupee. And that's something which is a terrible fate for anyone who had to suffer it. That's one type of risk. The second type of risk is there's an interest rate risk. So suppose you buy a bond and you get a particular yield on it. You're very happy with it. Let's say you get a 6% yield on the bond and you're happy. It's a very healthy yield today. But tomorrow the central bank decides to jack up rates because they feel like they need to basically tame the market. And what ends up happening is that now your yield is underperforming the market. Suppose the interest rate goes to 7.5%, your bond is yielding 6%. Only a fool would take that bond off your hands if you want to liquidate it for the same valuation which you paid for it. He'd probably say, look, if you paid 90 rupees for this bond, I want 80 rupees because I need to recover that extra amount which Federal Reserve or any other central bank has made possible in terms of raising the interest rate. So to give a competitive interest rate in the market, you'll have to take a haircut on your bonds price. So what that basically means is that you're paying for liquidity. So if you're investing in a bond, which is, let's say, a 10-year bond, and you want the money 3 years from now because, let's say, your mother needs to have an operation done and health insurance is not going to cover all of the costs, and you need to liquidate the 10-year bond, what ends up happening if the interest rate is now at 7.5 instead of 6% is that you will have to take a huge haircut on your bond price. That's the second risk. The third risk is an inflation risk. This is a little more nuanced and difficult to understand because we don't exactly see the inflation number flashing in front of us every day. Like how we see a stock ticker flashing in front of us, inflation risk is something which is more behind the scenes. Inflation risk is a lot like aging or the Grim Reaper. So, what ends up happening with inflation risk is that if your government fails to control inflation or even actively promotes inflation in your economy because it makes it, let's remember that inflation makes it easier for the government to pay back its debt. So they want inflation in the economy. But let's say the government goes too far, they're not able to control it. Let's say the inflation rate goes to 8%. We've seen it happen in the past. Let's say the inflation rate goes to 8% and you're being paid 6% on your bond. You are effectively losing 2% every year by lending to whatever corporation or government you're lending to. That's not great. You're losing, in real terms, you're losing money. That's the third kind of risk. Now that we know the three kinds of risks to bond investing, first I want to hear your thoughts on these three types and maybe which one is the most dangerous one, if there is one.
Well, first, my thing is risk. What is risk? Risk is what you're willing to lose, is basically what is risk in investment. And risk, like why you do investing, like the why in life keeps changing, why you do anything keeps changing. The risk also keeps evolving and changing. When you're younger, you have a larger appetite because you're like, I don't mind losing because I have a lot to gain. That's why a lot of youngsters nowadays like doing trading, because they don't feel there's risk in it, because the upside for them is so huge. As you get older, you can't afford to take those kinds of risk anymore because of other reasons, and then you slowly change your idea and your profile keeps changing. So this idea of risk also keeps evolving continuously. So you may be willing to take a certain bond at a certain risk when you're younger, and that may change as you get older, or your employment situation changes, or your life changes. Things can keep changing. So keep that in mind when it comes to bond and bond risks, so that you're keep that in view when you're considering bonds and how long you plan to hold bonds. Second thing, we have always professed in this channel and all our sister channels that you should not buy bonds and sell bonds and shares. Like how you trade in shares, you cannot trade in bonds. That we advise you to buy it and hold it to term. So when you buy bonds, our advice would be to put the kind of money in bonds where you do not need it till it comes to maturity. So if you have no other source of income, or emergency fund or insurance or anything else to count on, like Shashwat said, 3 years from now your mother needs hospital surgery or whatever and you need to liquidate the bond, you're reaching that kind of a situation, my first advice would be to create situations and circumstances around you first to make sure those kinds of things are covered. Like insurance would do most of that, and emergency funds would do most of that, and keeping a bit of gold would take care of that. After you do all that, then you come into investing into bonds, because bonds is an investment tool. It's not a speculation tool. So I would strongly advise against that, because if you can hold it to term, you don't have to worry about this interest rate arbitrage which happens, because you lock it in, you're happy with the interest you're getting, and from the interest you're investing back in the market. So any change happens, let's say you took it in 6% interest, and you're holding in for 2 years, and now interest rates have gone up and everyone's getting new bonds at a certain rate, no problem. You've been holding it for 2 years and you've been reinvesting those interests back in the market. You would be more than covered. Trust me, you'd be very happy where you are. You won't be having any problem, and you won't be comparing yourself to the market. So that is another thing. And as far as inflation risk is concerned, inflation numbers fortunately move gradually. Though in news and media we talk as if it's like going up and down erratically, it's not so. Like how interest rates by the central banks move very slowly and you can see it coming. Same way with inflation, you can see it coming. It's not like something which will suddenly creep upon you overnight and eat you alive, as long as you keep paying attention to what's happening. So these are my things which I want you to keep in mind with what Shashwat is saying as far as risk is concerned and interest rates are concerned and inflation risk is concerned. These are my thoughts which I wanted to add to this.
Just one more addition to what he said about inflation. This is why you have a diverse portfolio, because stocks are a good hedge against inflation generally. But if you read this book, you'll see that there's actually a chapter is about inflation and stocks. He basically says that one of those chapters, he talks about the relationship between inflation and stocks. It's true that at times there isn't an exact relationship between them, but generally, if it's demand pull inflation, then you should have a good relationship between inflation and stocks. If it's demand push and if it's supply pull, then there's a problem because your companies may not be doing as well as they would be otherwise, and you have inflation regardless. So that's something that you have to handle that separately. But generally speaking, having a diverse portfolio helps with this sort of scenario.
Yeah. So when he's talking about push and pull and supply, he's talking about specific companies you're investing into, or stocks or bonds of those companies you're buying. Is that the way to analyze the business of that company is what he's talking about. There's two ways companies do businesses. One is pushing and pulling. So that's what he's differentiating there. So when you read this book, you would understand that. And I'm sure when you read this book, you'll have 1,000 questions. If you do really get down to reading it, do reach out to us. We're here to help you guys get through this book and digest this book. The reason why Shashwat is reading it the third time now is for the same reason. Sometimes you need to chew your food before you can swallow it. So he's in the process of chewing it. He'll get there to swallowing, don't worry. Like all of us do. So keep that in mind when he's talking about that. What the push and pull is if you're getting confused and wondering what is he talking about.
Hopefully, we can cover some of these chapters in the Substack which we're working on, and hopefully we get that to you guys so that you can maybe read along while you can have us along while you read this book, because I'm quite excited about getting both of my uncles to help me with breaking down this book. That's why I'm picking it up again. So yeah, that's about it for this video.
Okay. So anyway, I hope you kind of got some overview on the way bonds work. And essentially what bonds are is you're lending money. You're the banker. Usually we go to the bank and we borrow money. Here the borrower comes to you and you're lending your money to the borrower directly. Usually the way we do it is when you leave it in the bank and the bank gives you an interest of 6% on your savings account, they in turn, they lend that money out at a higher interest rate. So what you're doing is removing the intermediary where the bank is making money off your money and you're directly making more money off your money. That's what bonds do. I hope you've understood that. And if you have any more questions regarding bonds and interest rates and this what we've spoken about, do mention down in the video comments below and we will try and get down to answering them in our other platforms such as Twitter and on Instagram. Thanks for watching the video again today, guys, and we'll see you in the next one soon.
Thank you.